Timo, thank you for joining us with the RAM Consulting Company. We're here to present you an investment opportunity that we've researched and think that you can highly profit from. Our team consists of our energy sector analyst, Ben Shepard, our economics analyst, Jakob, our investment strategy analyst, Demetrios, and myself, the ETF capital markets analyst. So today we are first going to start off by talking about the macroeconomic trends that guided our decision making, then go a little bit deeper into the energy industry, which is the industry we recommend investing in, then how we went on choosing the investment vehicle that we're going to use, and then our final decision on which investment to pick and which strategy to focus on.
Yeah, thanks, Timo. In times of uncertainty, it requires a lot of preparation work to find an appropriate investment. Hence, before we go into more detail about our investment strategy, it is important and necessary to understand the current macroeconomic circumstances. Saying that, I would like to provide you a short overview about the current and upcoming trends. First, let me give you some statistics and facts about the global economic situation based on selected well-known indicators. The projected inflation for 2022 will reach 7.4%, as you can see on the slide, equals to the highest annual increase since 1996. And as we know, the Fed's target inflation rate is 2%. The too high inflation has a negative impact on the purchasing power, but it also has an impact of other macroeconomic key figures, which can be observed from the upcoming slide. For example, it leads to increasing interest rates and can also cause a recession. Hence, according to the Global Competitiveness Report, the current trend is the stagnating productivity growth, or with other words, the global ratio of aggregate output as to aggregate inputs. As you can see on the chart on the right-hand side, even there has been exceptional years with higher growth, the total factor productivity decreases on average over the recent years. However, there are also profit years from the recession. The energy commodities, for example, tend to outperform. Taking all information into consideration, what could be the reasons for the sobering situation we have right now? To give an answer on this question, we need to examine the current influences on the macroeconomy. There are three concerning issues which currently require special attention and are supposed to be the initiator of the high inflation rates and the recession. First, the global world has not fully recovered yet from the damage the pandemic has caused. Without going more specifically into the topic, COVID-19 was responsible for the global GDP decrease of 3.9% during the period of 2019 and 2020, and was the initiator for the following inflation. The second big issue causing economic problems and high costs is the climate change. The consequences of the climate change, for example, will lead to relocation of whole towns, shrinking productivity of farmers, higher prices of basic foodstuffs and consumer goods, and to more wars to gain access to limited resources, etc. Every year, climatic disasters cause large economic damage. Over the past decade, direct damages of such disasters are estimated to add up to around $1.3 trillion. The third big issue is defined by geographical conflict. The most recent example is the war between Russia and Ukraine. On the day the invasion started, financial markets around the world fell sharply, and the prices of oil, natural gas metals, and food commodities surged. In this context, we can assume forecasts for upcoming trends in terms of the global economy. Because of the current circumstances, the economy is subject to risk of stagflation, meaning that the inflation will rise continuously in the future while an appropriate growth of GDP is missing. Generally, real estate sales are expected to drop as the prices remain high. Further, the COVID-0 policy of China and their persistent lockdowns will increase economic pressure around the world, as China accounts for nearly 30% of global manufacturing output. In terms of the consequence of the climate change, a 2022 analysis from S&P Global believes that it could result in up to 4.5% reduction in global GDP by 2050. As countries institute climate change efforts, unintended consequences in the economy are expected, meaning an increase in the price of energy and materials due to the transition to green energy. In this context, we can refer to the consequences of the Russia-Ukraine war we have mentioned as one of the current key influences in the macroeconomy. As you can see on this slide, the impact of the war spreads in different sectors of the economy. Since Russia accounted more than 40% of the European natural gas imports, economists are warning that the ongoing sanctions imposed on Russian energy commodities could trigger a recession. It is therefore not surprising that the war causes a strong negative impact in the terms of energy supply. It also affects the price index of the energy sector as energy commodities raised sharply since 2020. The average energy bills in the UK, for example, are likely to increase by 80% in the upcoming 14 months. Shep, you can go ahead.
Thank you, Jakob. The macroeconomic environment is seen as a massive indicator of where the energy sector is going to react and gear towards. So in recent years, we've seen oil prices match. In this instance, we chose the XLE ETF, which is an energy sector ETF. Typically, it moves in the same area. But as you can see, in 2020, we had the pandemic. Initially, all the markets, SPY, NASDAQ, they all crashed because of massive closure amongst all continents and countries. So this affected oil prices as there was no demand. So prices just fell off the face of the earth. Once these prices did and demand rose quite a bit, the market did recover. The market recovered quicker than the energy sector, as many places, such as China that Jakob mentioned, were still imposing some very important travel restrictions and lockdowns. So these lockdowns actually subdued the gains of the energy sector. And that's what we see in late of 2021. We see a massive increase in oil prices and we don't see a massive increase in the actual performance of the energy sector. As you can see, the high growth companies of SPY that largely dictate where SPY moves performed extremely well throughout 2021 and into 2022, the start of 2022. And the energy sector picked up in 2022, just lagging behind SPY. The past year, though, has been great for the energy sector in comparison to SPY and QQQ. Year to date, the energy sector of SPY is up 53%, while QQQ, which is largely technology stocks, is down 32%. This was caused mainly by another macro environment, as Jakob mentioned, the Ukraine conflict. Russia seized control of many parts of Ukraine, and they have a massive impact on the overall energy supply of the world. They've cut off a lot of the supply into a lot of Western Europe and Eastern to Western Europe, and this is seen as a huge negative for markets globally, but for the energy sector, since there is so little supply, prices have shot up, and this has made companies very, very profitable. And we see that throughout the year. As you can see, the crossing point is the 1st of March, and Ukraine was invaded late in February. So it's a direct correlation with the conflict, and it's been ongoing. Some peaks and valleys have happened in the most recent months because of different OPEC supply halts and American companies trying to up their supply and productivity to counteract the Russian supply halt. And analysts across the country and world believe that right now energy sector is overweight by quite a bit, and it's the only sector that is overweight. We're heading very strongly towards a recession, and most of these other sectors are going to perform very poorly. The energy sector, though, is seen as one that can produce profits through this recession because of all the macroeconomic activity. And we also see this as very profitable, as the PE has been very low. And to go off of this, the PEG, which compares sector to sector, is also relatively low. So we're seeing that there's immense amount of value that is in the energy sector. And a lot of that value left in the initial recovery from COVID, and it flew into growth stocks. And now we're seeing those growth stocks take tremendous losses, and more people are starting to throw that money away from growth and into energy. And we think that this high dividend yield is going to be very lucrative, as these companies that have lagged behind the S&P are going to be reporting record profits. ExxonMobil just recorded record profits and turned double-digit returns after their Q3 or their Q2 earnings report. So we see a lot of growth in this sector for the next at least year, 2 years. To go off of this, gas and oil is poised to accelerate, as McKinsey has reported. These high commodity prices will continue to rise. We've had a temporary pullback on energy prices, as crude is around 90 or around 90-ish, 80s a gallon. And many analysts are seeing that this price could go up into the triple digits and beyond. This is in turn going to cause a massive amount of hurt in a lot of areas. So many companies are being bought out by European countries trying to ease the blow for their consumers. This is leading to more supply, but the prices are relatively going to go unchanged for the foreseeable future. And so we see demand is still going to remain high, and these prices will still remain high, leading to large profits in the next few years. After the night, to go off of this, Biden asked Saudis to not limit their supply, but OPEC declined, and they are going to be starting their pullback of 2 million barrels a day, trying to increase their supply internally, and not going to be releasing as much barrels of energy. This will create a massive shortage in the industry, and will continue to remain or give profits to these American companies, and which is largely held in the XLE ETF. As we see more long-term trajectory, we see the role of energy changing immensely. The net zero initiative is moving fast, and by 2050, many of the developed world is hoping to go net zero. This means a lot of additions to the energy sector from renewables and electricity, and fossil fuels, oil and gas will decline in the sector. This does not mean the sector is necessarily going to decline as a whole. The oil and gas part of the sector will. Energy should still be a good investment for the long term, showing relatively good growth. But for the long term in XLE, it will not be as profitable because XLE is heavy on the oil side. Now, if these oil companies with their massive amounts of wealth want to create more electricity, more renewable energy, then they could continue to gain market share and remain profitable. But we see this more as a short-term investment.
Thank you, Ben. So now that we've seen how profitable an investment in the energy industry could be, we have to determine which vehicle we're going to use and what we're going to invest in. And I've put up here some criteria where we can evaluate which form would be the best to invest in. And that is divided between equity and debt. In the equity section is individual stock, mutual funds, and ETFs. And in the debt section is bonds. And starting off, first of all, with arguably one of the most important aspects is past and forecasted return. And as we heard already, it is very, very lucrative to invest in both individual stocks, mutual funds, and ETFs. Bonds going off of that are coming from individual stocks. And with interest rates rising, they are not as profitable, which is why they only get a finger in the middle. The next one is diversification benefits. And of course, if you invest in individual stocks, you do not get any diversification benefits and take on the full market risk. Whereas mutual funds and ETFs, they are very well diversified with a lot of holdings. And the same applies to bonds in terms of stocks, where they're not very well diversified. With individual stocks, there are, of course, no management fees, where there are pretty high, with mutual funds going up to about 1.4% of the holdings. And with ETFs, they're about, they can range about 0.07 or 0.7%. And the bonds, of course, they're free as well. With the transparency, of course, you can always see how and intraday pricing, how your stock is priced and at what level they are. With mutual funds, that's a bit different. You don't have that transparency. It only comes out at the end of the quarter. You can have a view into how that is going. With ETFs, it's very transparent. You can always see what is in the portfolio of the ETF, and with bonds, obviously, as well. They're very, you can see what's going on there. And now we've based our decision of that and decided that an ETF would be the best alternative because it is very well diversified and you're not putting all the risk into one asset. So next one, please. Thank you. So here we put together a list of all energy funds that have total assets under management higher than $100 million. And this list is not supposed to be this list is not supposed to, you're not supposed to go through this list. It's just to show that there are a lot of different opportunities. And then we started kind of crossing out some of the things in the list, starting with adjacent industries, which is, for example, clean energy and equipment and oil equipment and services and stuff like that. And as we can see, we got almost half of the ETFs from that list. Next, we went on to focus on the upstream focused ETFs, because especially in times where oil prices are high, these are a lot more profitable and go up a lot more in price, as you can see here. For the few that are not, that are still remaining in the set, they have very high returns year to date. The next thing that we looked at was leveraged ETFs, because especially the strategy that we want to provide you with, leveraged ETFs just are not profitable and don't fit into that strategy. And the last thing that we did to this list was we want an ETF that has a high volume. We chose 1 million trading volume or an average volume of over 1 million, because we want to know that this is actually an ETF that people invest in, that they actively trade. And so with this process of elimination, we were left with 3 ETFs, which Dimitri is going into a little bit more detail with now.
Thank you, Timo. As you can see here in the table, we will compare XLE, XOP, and IYE. We can see that the highest price is XOP's ETF, which also has 10 times smaller size than the XLE ETF, but double the size of IYE. We can see that IYE has half of the price of XLE, and also 20 times smaller the size of XLE. Here we will see the top 5 holdings of each ETF. We can see that XLE and IYE, their top 4 holdings are all the same. Also, we can see that XLE and IYE, their top 5 holdings result to 50% to more than 50% of the total assets, and XOP's top 5 holdings result to a little bit less than 50% of its total assets. Here we will compare the performance from the ETFs. The 1 year and the next slide of 5 years comparison. We can see that XLE and IYE have similar performance. And on the following slide, the 10 years performance, we can see that both XLE and IYE outperform the XOP ETF. So that is the reason that we will go to and decide between XLE and IYE, as we think they are similar ETFs, and we will decide from a little bit of the statistics data that we selected to see which one is a better investment in the short term. We can see, as we said before, that XLE is double the price from IYE. Each expense ratio is a lot less than IYE. The size is 20 times more. Dividend is a little bit more. The Sharpe ratio is pretty similar, and the volatility is similar too. A little bit about the returns. We can see that since January 4, 2010, XLE has a total return of 114.67%, which is higher than IYE's total return of close to 90%. Also, the maximum drawdown of XLE for that period was minus 71.54%, which is pretty similar and equal to IYE's drawdown of 73.85%. So we decided to go with XLE based on the selected data and the historical performances, because that ETF has the biggest AUM. Its portfolio consists 50% of the top 5 holdings. The expense ratio is small compared to competitors. The dividend yield is higher compared to competitors. The total return is higher, and the maximum drawdown is similar to its competitors. Here we are going to decide about the investment strategy. We can see that between the market and the ETF, in 1 year and 2 years comparisons, the ETF outperforms the market. But in 5 years and 10 years and 20 years, the market outperforms the ETF. So we decided to go with a long-short investment strategy. We will long the ETF and we will short the market. We decided to go with a short-term investment, 2-year long, as we are trying to minimize the losses in case XLE drops. What is the investment risk? We decide that if the XLE drops and the market increases, or if the investment cannot pay the interest of shorting the market, if the stock loans become more expensive and if the stock loans get recalled, then we will have a problem with our investment. Thank you.